if you want to know where the economy is headed, don't watch the Fed. Track this interest rate instead. Anything above 4% is bad. And if you read this article on Business Insider, what you'll see is that the 10-year Treasury, when it's over 4%, when they make loans, say they make loans at 5% and they bundle them into a mortgage-backed security and they sell them as an investment, paying 5%. Well, when U.S. Treasuries with no risk whatsoever, well, not no risk, but they contain low risk because they're going to make you work to pay them in the future out of your future taxes. That's where the income comes from for Treasuries. But investors won't want your 5% bond because they carry more risk than the 4% Treasury. So the mortgage lender must charge about 7% for that 30-year fixed rate loan. So loans jump. So here is the 30-year fixed rate mortgage. Now I wanted to take a closer look at these mortgages. So here's the 10-year Treasury note, and I'm going to change this to all data, and now it goes back to 2006. So you can see at the height of the real estate bubble, it was 4.5%, but we were coming down from high, the rates had been falling since the 80s, and then they bottomed right here, and they're bottoming here at a 10-year Treasury is 0.6%, and today it is 4.014. So anything above 4% is bad. So as this rises, it becomes harder and harder to sell all of these packaged loans that banks have made because there's just not enough spread between what they can get as a perceived risk-free, even though it's no longer risk-free, and what the risk is that they're taking. So here's the 10-year Treasury going all the way back to 1962. And what you see here is, this rise, and I keep on saying things like nothing like this in history has ever happened before. And then you look at this area here, and it looks like the steepness of the rise and the size of the scale of it is equal, if not greater, back in the late 70s, early 80s. But we're starting at about 7.5% here and going up to almost 16%. So a doubling. Here, we're starting at a yield of 0.55 and going up to 4.1%. Now, if we take this and we do percent change from a year ago, what you see is that, yes, nothing like this has ever happened in history before. That's daily. Let's go monthly and see what happens. Well, yep, nothing like this has happened before. The magnitude of the change, quarterly, semi-annual, annual, yeah, nothing. I mean, this is about 4 times greater than has ever happened before, that in the data sets that are available. So here is the 30-year fixed rate mortgage in the United States, and it looks like the same thing. This looks like a really big move here from 2.73% all the way up to 7.08%. That is a big move. Here you're talking about 8% to 18%. So this is a bigger move, but since it's coming off of a higher launch pad, it's not as large on a percentage basis. So let's take a look at that percent change, and whoa, nothing like this has happened before. So this is going to have an enormous impact. Here's annual, and you can see nothing like this has happened before. We're up at 80%, so it's 4 times what happened back in 1980. The shock to the entire financial system. Everything runs on debt and interest rates now, and everything is sensitive to it. So, this affects everything. And so price of a typical starter home fell in San Francisco, Austin, and Phoenix, bucking the national trend. So nationwide, things are going up, but now we're starting to see the holes develop in the economy. This is household net worth, and it's the change, percent change from a year ago. So it's falling now. And, it fell during the 2008 recession. There are so many indicators that say that we are currently in a recession right now, but then there are other indicators pointing the opposite direction. But this one is suggesting that, yes, we are in a recession, and I believe that certain sectors of the economy are. So the big news, though, what is it that's going to implode the economy? You just do an internet search for empty office buildings. Next crisis will start with empty office buildings. What will happen to all the empty office buildings? Is it really the perfect storm? Why are there so many empty office buildings? And then you do a search for office building mortgage defaults. Office landlords defaults are escalating. Companies are defaulting on loan payments. This one, I'll show you the story later. Real estate giant Brookfield Property defaults. And then Forbes. Office buildings are still less than 50% occupied. Who should worry? You should worry. We should all worry. 2 office landlords defaulting may be just the beginning, with at least $92 billion in office mortgages maturing this year. This year. $92 billion this year. And so this is an ongoing problem. Now, when you have investment real estate that you lease out, the value of your property is determined more by the mortgage rates. You know, they calculate. There should be a certain vacancy rate depending on how many offices or spaces you have, apartments, whatever it is. There's a certain vacancy rate that is expected. If it's too low, it means that you're not charging enough rent. If it's too high, it means you've got to drop your rent or there's something else wrong with the building. So as the vacancy rates go up, the value of the property declines. It isn't the structure, it isn't the location, it's how many spaces are rented. What is the vacancy? And this means that when a whole lot of these big landlords, these property owners that own these multi-billion-dollar buildings, when they have to refinance at these higher rates and their value of their building won't allow them to refinance for the amount that they've already got that's already outstanding on their previous loan, they're sort of screwed. They have to do jingle mail, it was called, where you just mail the keys back to the lien holder.